and welcome to Fidelity Connects. I'm Pamela Ritchie. After weeks of volatility, some of the tech giants like Meta and Microsoft beat Wall Street expectations and are actually stabilizing and in some cases lifting indices higher. Now, although earnings helped out the tech stock prices in certain cases, it's important to remember that the results, Q1 results, reflect a period before Liberation Day or April 2nd. So it's all about looking ahead from here with a longer-term lens. So how is our next guest thinking about positioning and which tech sub-industry, ultimately, is he leaning into? Joining us here today to unpack what is shaping the tech sector and how he's using his strategy to find opportunity is Technology Innovators Fund Portfolio Manager, Hyunho Sohn. Welcome, Hyunho. Great to see you. How are you doing?
I'm good, thank you. How are you, Pamela?
I'm very well, and I'm actually really looking forward to this conversation. There's so many moving parts in the market that we've sort of been waiting months to ask you about, so here you are. I wonder if you might begin just a little bit reminding everyone the landscape, the universe in which you invest for those that want to be in tech innovation names.
So basically, I manage a Fidelity Technology Innovators Fund. My universe is technology industry. So basically what I do is try to identify and invest in company that can capitalize a long-term trend in technology. So my investment process and style is basically I'm very much a bottom-up stock picker. When I think about my advantage investing, because the investing is very competitive. There are a lot of smart investors in the market. But my advantage is Fidelity has a lot of research analysts, more than 30 analysts looking at tech sector globally in North America, Europe, and Asia. Supporting me and other fund managers, and I get a lot of bottom-up ideas about what companies are making the good money in the tech sector. So I'm a lot of very much a bottom-up stock picker. Mm-hmm. And also, if I think about my personality, I'm naturally more conservative, and I like to think. Against the consensus. I've been in the industry for 25 years, more than 15 years looking at tech, and predicting future is actually can be quite difficult, and a lot of times I get wrong, and my experience is that losing less money when things go wrong is actually very important. And this fits into my personality and style. Mm-hmm. So if I am more valuation discipline, if I'm being against the consensus, even though sometimes I get wrong, I lose less money. And this kind of process worked over time.
Yes, and it's worked, I think, over the last little while, which has seen a wild market ride. I wonder, just because we mentioned some earnings, these are U.S. earnings that we're talking about, that we've come through the earnings season for Q1. Everyone saw the reaction to earnings, and there's been a massive valuation change, obviously, in sort of the household tech names out of the U.S. Can we just begin with a little bit of your view of what we saw on the valuation side of things, on a little bit of a round trip story over the course of the last sort of 6, 7, 8 months, maybe even a year. I don't know how long you want to take it back, but the big tech hyperscaler names. Tell us about the journey that you've watched, and at what point you thought maybe that's enough, or I don't know.
So, the recent earnings, if I can round up, actually, earnings of the big tech companies have been relatively solid, particularly given that there were a lot of concern about macroeconomic conditions and tariff-related issues, etc. But companies, for example, cloud computing, the companies like Microsoft, Amazon, they've been delivering a decent number. digital advertising franchises like Meta and Alphabet, despite concern on macro impact on advertising, the earnings have been pretty solid. And there was a little bit of concern about cost inflation because of tariff-related issue, but more pretty much a lot of companies have been earnings and margins have been quite solid.
So when we have watched the change in valuation, I mean, it sounds like they earned the earnings that they've had over the course of the last year, but nonetheless, we've seen a huge slide on the valuation side of things. I mean, how do you put that together?
So on tech valuation, I think valuation has come off quite a bit, particularly so far this year. We saw the big reversal in the tech sector. Last year, AI drove a lot of the market sentiment and the valuation of tech sector. But so far this year, we saw quite significant reversal of that. And overall, tech sector valuation has come off a little bit.
Right, a little bit. So what did the DeepSeek moment, I literally been waiting months to ask you this question, what did that moment mean for valuations ultimately? I mean, how did you, it's not like DeepSeek was a company you'd probably never heard of. You would have seen it coming on some level. But it was quite a moment in the markets when it was discovered that perhaps all the CapEx spending wasn't necessary. I mean, how did you digest that moment?
Yeah, I mean, DeepSeek surprised investors, since, firstly, huge innovation happened in China, and DeepSeek and China AI ecosystem have been able to deliver innovative technology in a much cost-effective way. And that led to concern about overall capex related to AI. Given AI infrastructure can be delivered in a much more cost-efficient way than maybe capex that we saw so far may not be sustainable. That kind of concern happened in the market that led to quite significant derating in the sector, particularly the AI-related semiconductor names that we saw significant derating. Overall, I think I'm quite constructive in tech sector, including AI, in terms of.
Is this in China? Sorry to interrupt you. Quite constructive globally, or?
I mean, in terms of more proliferation of AI, because cost of AI is reducing quite significantly. So I think there is going to be more adoption of AI. So basically, usage of AI will increase, adoption, penetration will increase. That's globally and not just limited to China. But then, I'm a little bit negative on AI capex, given, again, I mentioned earlier, because AI capex, AI infrastructure can be delivered much more cost-effective way. So the level of capex spending we saw might not be sustainable, in my view.
Okay, that's really interesting. That said, it doesn't really. Let's go to actually the China ecosystem that you were speaking about specifically. Everything from the discussions of geopolitical, which is probably not what you want to focus on because you're a bottoms-up investor. But in any case, there's a big discussion about whether semis and the ecosystems of North America, Europe, and China can actually work in a complementary way or not. One way or the other, how do you invest that?
I think my strategy is to identify companies that are competitive globally. So obviously in tech, North America, in US, there are a lot of industry leading companies that have very strong competitive advantage. We find it hyperscalers, internet companies, software companies. But there are strong franchises outside of U.S. So in Europe, software, telecom equipment, fintech business. There are globally competitive businesses, and in emerging market as well. I mean, TSMC is a good example. And China, I'm very optimistic about the finding opportunity in China, because DeepSeek, as you saw in the DeepSeek moment, innovation is happening there, and not just AI related, but also the electric vehicle, the battery technology, even semiconductor technology. It is developing quite quickly, so the innovation is there. And companies have been delivering strong earnings power even under pretty weak the macro environment over the last 2 years. And because of the market concern on China in terms of geopolitical concern, stocks are not very traded in expensive of the valuation. So I see quite good investment opportunities in China.
And which areas? So you mentioned software, particularly on EVs, you mentioned as well. The semiconductor side of things, there's some big names in this. Is this an area that, tell us about the demand. It's a cyclical business. AI has sort of a new piece of a structural / cyclical on top of that. But tell us about the semiconductor side of things and the demand story there.
I mean, in semiconductor, there are, different subsectors. So obviously, the AI is a big driver at this point, and demand for semiconductor in AI space is still quite strong. There are a lot more demand than supply at this point. So, pricing environment is strong. The company's margin profile is strong. Outside of AI-related semiconductor, there are semiconductors that are exposed to broad-based economy, industrial, automotive-related semiconductor. That part of semiconductor demand has been quite weak over the last 2-3 years. And the weak demand was exacerbated by high level of inventories in the system. So we saw a lot of inventory destocking in auto and industrial exposed semiconductor space. We are beginning to see some signs of stabilization. Obviously, macro is quite uncertain, but things are not getting worse from here. And some companies are seeing some orders expediting. Company saying about lean inventory in the channel. So we are seeing some signs of improvement in the space.
Okay, and is that an area then where it's sort of there's an opportunity? Is that an area that you've seen going forward you'd like to lean into?
Yes, I'm quite overexposed to the industrial and automotive exposed analog microcontroller semiconductor space. Obviously, from a cyclical point of view, I think we are near very trough of the cycle, but also structurally, I like these companies' business model. It's very fragmented customer base, but industry gets consolidating. The high margin, high return on investment profile, which I like. So I find quite a lot of a good the company in the analog and microcontroller space.
That's really interesting. Is that an area that is somewhat less, or give us the contours of how it responds to the entire tariff story, which is a massive story? You might want to give us your thoughts on where you see movement there, the tariff, companies that are less exposed, more exposed, areas perhaps that are more localized. How do you invest amidst the waves and the tides of tariff talk?
So tariff is a very complex and situations are fluid. The way I think about tariff is I try not to overreact on headline because stocks move a lot on the headline, but I think more about long-term implication. What company can handle this issue in the long term? Because in the short term, whether tariff will increase or stay high or decline, things change very quickly. So we don't know what's going to be like the short-term implication. But in the end, I think the company that have been managing global supply chain efficiently in a cost-effective way, I think those companies can handle all the dynamic tariff situation quite effectively. And tariff in general will elevate cost inflation. I think companies that have strong pricing power will handle this issue more effectively. So in the analog and microcontroller space, I think we can find companies that have good fundamental characteristics from that standpoint.
In terms of semiconductor manufacturing within China, like anything that's manufactured, there are components that can be found inside a domestic economy and components that have relied on trade. Take us to China a little bit and how the manufacturing side of things for semiconductors is doing. Are they retooling themselves in reaction to tariffs? Maybe they already did that.
I mean, there's a lot of localization effort that happening in China. So, China overall want to diversify their sources. I mean, localization effort is a big thing for them. For example, semiconductor equipment space, China has been importing a lot of the critical semiconductor equipment from US, Japan, and Europe. They are still importing a lot of equipment, but localization is happening quite quickly. So already there are a few semiconductor equipment companies that quickly replacing the global semiconductor equipment companies in China. In the analog semiconductor space, again, China imports a lot of analog microcontroller semiconductor, and there are a few local China-based semiconductor companies, increasing the market share in local market.
And presumably you're invested in the ones that are useful to be invested in?
Yes,
Can you tell us a little
I'm
about
particularly interested in the analog semiconductor, the market, local Chinese player, given size of the market is very significant, and their market share gaining story is quite compelling. So I'm interested in this space.
Okay, it's so fascinating, and it's a space that a lot of people don't have too much familiarity with. Let's launch back into the AI discussion. Ultimately, the CapEx story. I think just your thoughts on who's going to make significant money out of this. I think X months ago, was it a year ago? I don't know, 8 months ago, we were also talking about, yes, the AI companies are the hyperscalers and the partnerships with which they have made, but we're all waiting for the killer app. It's all going to be a case of sort of waiting. Is that still the story? Is it a killer app one day that comes that will be the hugest beneficiary of the movement towards everything coming under the umbrella of AI? Qui bene? Who benefits?
I think the big internet companies are natural beneficiary of AI. When we think about AI adoption in the consumer world as well as enterprise world, I think consumer space AI adoption is happening very quickly. Good example is targeted advertising, more personalized advertising, those things, and content generation. AI is being used because in the consumer overall is the I think more risk tolerant and creative economy, content creation and that kind of world. That I think the AI is adopted more quickly, whereas in the enterprise world, AI adoption is happening more slowly.
Why is that? Why do you think that is?
Because corporates are, firstly, underlying infrastructure is quite complex. Data infrastructure is quite complex. When the corporate, thinking about AI, deploying AI, companies need to think about risk of getting wrong, data security, data privacy of the consumer data, and all sort of things are quite complex, and companies need to be aware of risk using AI. So that's why the enterprise AI adoption is happening more slowly. If you think about key component success of AI, either capital, technology, and human resources, and those big internet companies have all those.
Okay. Give us a sense for everything that you've just laid out, including the way you invest and sort of your style and some of the different cyclical elements of what you're looking for. How are you positioned? Give us some idea, even if it's a bit top down, of what you're exposed to, underweighted, so on.
Yeah. So firstly, I'm quite underweight in AI capex related. So I'm very underweight in the AI semiconductor names, given that
even the big ones that we know, the household ones.
Yeah. So for example, I don't own NVIDIA. I don't have Broadcom, for example. I mean, obviously, these companies are very good company, very respectable. The company run by, strong CEO. But given the level of capex that we saw over the last 2 years or so, is, unsustainable in my view, because if I think about the hyperscaler, they have spent a lot of capex. I mean, if I look at the capex intensity of the hyperscalers, capital spending divided by revenue at a historical high level, and also a lot of AI, semiconductor demand is driven by so-called neo cloud, tier 2 cloud, AI startups. Those capex was driven by strong external funding, and a lot of those tier 2 neo cloud and AI startups are not generating the cash flow. So external capital has to be continued to provide, continue to support AI capex, which I think it's unsustainable in my view. So I'm very underweight in AI, capex related names. I'm overweight large internet space, given I believe the hyperscalers are natural beneficiary as AI proliferates, and I'm overweight in China, given that I identify a lot of the internet semiconductor software business in China that have a long-term growth story, trading at an attractive valuation. And in the software space, I'm exposed to software that is more exposed to manufacturing and industrial names, so-called design software space. I'm exposed there. And also I am exposed to the video gaming companies. In the uncertain macroeconomic environment, video game demand is relatively stable, and the companies are monetizing their user base quite effectively. So yeah, those are the key area that I'm investing in.
It's fascinating to get your views on what you've been watching and some of the conclusions that you and your team have come to. Hyunho Sohn, thank you. I think we'll leave it there, and we look forward to speaking to you again soon.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.